Is the U.S. economy on the edge of a major recession? And if it is, what impact will that have on home prices, stock prices, and the unemployment rate? In this video, we're going to explore the new developments that seem to be making the economy falter. We'll begin by discussing President Trump's stance on tariffs, then move on to Warren Buffett's recent alarming remarks, and how all of this is starting to feel like a repeat of 2008. Let's begin with an important fact. Between February 19th and March 13th, during a 17-day trading span, the S&P 500 dropped by 10%. This sudden decline officially marks a stock market correction, the first since 2022. The sharpness of this drop has many investors believing that what we're seeing now might just be the beginning of a prolonged recession. To understand why so many believe a recession is imminent, let's look at some context. On November 25, 2024, Donald Trump won the election and immediately announced plans to impose a 25% tariff on all imports from Canada and Mexico, along with a 10% tariff on imports from China. At the time, the S&P 500 was at near record highs, having surged 74% since 2020 and 181% since 2016. It was clear to anyone paying attention that the U.S. economy had been thriving for the past 15 years. Critics may say otherwise, but unemployment was at historical lows, and we hadn't experienced a true recession since 2009. For an entire generation, economic collapse had been nothing but a distant memory. From a Wall Street perspective, these were the best of times. Profits were high, and risk seemed almost non-existent. Looking at the markets, you could argue that the economy was operating in what could only be described as a massive bubble. By virtually every measure, including the famous Buffett indicator, which compares stock market valuations to GDP, the value of stocks had reached levels far beyond any reasonable historical benchmarks. This massive bull market continued to roar until mid-December 2024. At that point, foreign governments, Mexico, China, and Canada, began suggesting they might retaliate if these tariffs were implemented. Looking at the market charts, you can see that this was when investor sentiment started to shift. The market began to get nervous, unsure of whether or not the trade war was truly going to materialize. From this moment onward, things in the markets started to take a downward turn. By January 20th, 2025, Trump was inaugurated, and just 48 hours later, draft executive orders for the Canada and Mexico tariffs were circulating within the Commerce Department. Despite this, the market remained relatively stable, as many had expected these tariffs to be used merely as leverage in negotiations, with no intention of being enforced long-term. But on January 29, 2025, Trump signed the tariff orders into law, setting them to take effect on February 5th. However, in an unexpected twist, on February 3rd, he announced a 30-day pause on the tariffs. This led to a sense of uncertainty in the markets, as traders weren't sure whether the tariffs would ultimately go into effect or not. Over the next several days, the sentiment started to shift even further, with the increasing expectation that the tariffs would return. And this time, they wouldn't be just a bargaining tactic. By March 5th, China was also involved, with Trump imposing a blanket 10% tariff on Chinese goods. The 30-day pause eventually expired, and with it came the realization that the tariffs were here to stay. By then, the markets were already in a steep decline, with investors pricing in the long-term consequences. Mexico would eventually receive a temporary pause on their tariffs, but Canada got slapped with a 25% tariff, while China's tariffs were raised to 20%. China responded with retaliatory tariffs, and soon after, Canada and Mexico were threatening retaliation of their own. Now, I'm not going to get bogged down in the intricate back and forth of these tariff negotiations, as it gets pretty complex and changes daily. Instead, let's turn our focus to the bigger picture and examine why so many believe these actions could trigger a serious recession. As you can see from the chart, things have not been looking good lately. A significant part of the reason is a shift in economic thinking. Many high-level economists and financial experts are now of the view that tariffs in the 21st century are essentially an act of war. And one such figure who agrees with this sentiment is none other than Warren Buffett.
How do you think tariffs will affect the economy? I mean, tariffs are actually, we've had a lot of experience with them. They're an act of war to some degree.
Warren Buffett's perspective isn't without merit. This comparison to war makes sense, especially when retaliatory tariffs are involved. A cycle of such actions could easily disrupt the entire global economy, and it's a primary reason we're seeing such dramatic shifts in stock prices. For many investors and corporations, tariffs feel akin to an economic bomb, a policy that could dramatically impact growth and stability. As these tariffs transition from threats to reality, the repercussions could be far-reaching. The stock market is reacting, and it's only a matter of time before the housing market and, eventually, the job market follow suit. Americans often express a desire for everything to be made in America, especially when it comes to the owners of companies that send factories overseas. But as we know, in the world of the free market, things don't always play out that way, for some very clear reasons. Referring to Warren Buffett again, data suggests that he has been preparing for the worst in the U.S. for months. There have been stories circulating about how Berkshire Hathaway is sitting on a record amount of cash, and with the S&P 500 recently dipping into corrective territory, Buffett is increasingly investing in Japan. Keep in mind, this is the same Warren Buffett who has repeatedly said that investing in America and American businesses is the way to go, and now he's diversifying away from the S&P 500. However, the most successful investors often argue that diversifying your portfolio among different asset classes can provide even greater protection. One asset class that has been steadily trending upward by several metrics over the past few years, despite the chaos in the stock market, is the fine art market. This market saw two headline-making auctions even as the S&P 500 was heading into correction territory. Now, I'll be honest, I'm not an art collector, but that's exactly the point. The fine art market is an alternative asset class, and one that's likely to continue growing in the long term. A 2023 study by Deloitte estimated that the total wealth in art and collectibles was nearly $2.2 trillion, and it's projected to hit almost $2.9 trillion next year, leaving plenty of room for potential upside. Now, I won't bore you with more philosophical discussions on tariffs and politics. Let's shift gears and talk about why so many on Wall Street are warning about a looming recession. And this all ties back to a new concept on Wall Street called pretend and delay. This is a key factor contributing to the current economic spiral, and it's also why a recession could be just around the corner. Pretend and delay is easy to understand. For example, if Apple decided to produce the iPhone in America, it would likely cost around $500 more. I've guesstimated this figure, but it's likely close considering the wage differences between the US and Asia. This isn't surprising to anyone, but if Apple were to do this, the iPhone would become less competitive in the US market, especially when competing against other phone companies that make similar phones overseas for a fraction of the price. This is where tariffs come into play. You can artificially solve this issue by introducing a tariff on foreign-made phones, which would raise their prices, bringing them more in line with an American-made iPhone. But here's the massive problem. Everyone in the marketplace knows that these tariffs are artificially created and upheld by politics. And as we know, in America, politics can change with the wind every 4 years. That means Apple could invest billions into American factories, but in 4 years, a new administration could sign a bill that wipes out those investments overnight, especially if the tariffs are removed. The CEOs of these companies aren't naive. They understand the game. It's a game of chess, not checkers. First, they pretend to support onshoring production, but they never fully commit. They'll make vague announcements about building or planning to build factories over a long 4 to 20-year period. This is a win for the administration, as they can boast about bringing back American manufacturing. Meanwhile, Apple understands that as tariff tensions rise and retaliatory measures kick in, the economy will likely weaken. When that happens, public sentiment can shift rapidly, and presidents can become deeply unpopular almost overnight as job losses mount. So, the political pressure will eventually force a rollback of the tariffs. And when that happens, companies like Apple will have hedged their bets. They'll endure a recession, wait for the tariffs to be lifted, and avoid committing fully to American manufacturing, knowing that when tariffs are removed, their massive investments in American factories could become uncompetitive. By stalling and playing along, they're securing a path to long-term survival. It's not an ideal strategy, but it's the most realistic one. While this might sound simple, simplicity is often the hardest thing to achieve in business. It's the greatest art. And we're seeing it happen now with dozens of companies using the pretend and delay strategy. But what exactly are these companies preparing for? To understand this, we need to turn to someone like Jeffrey Gundlach, widely known as the Bond King. Gundlach is sounding the alarm about a looming recession, and he's been very clear about his concern. Bonds tend to lead the market when it comes to shifts in the economy, and Gundlach is definitely concerned. He recently appeared on CNBC to discuss the state of the U.S. economy, and his message was clear. The economy isn't just on the verge of getting bad, it's already in rough shape. Before we dive into exactly what he said, here's a shocking prediction. Gundlach expects the Fed to start cutting interest rates by July. On the surface, rate cuts might seem like good news for the economy, but history tells a different story. Take a look at past recessions. In 2000, the Fed began cutting rates, and shortly afterward, the recession hit. The same thing happened in 2007, rate cuts followed by a crash. Even in 2019, the Fed started cutting rates before the brief but sharp COVID recession. The pattern is clear. When the Fed starts cutting rates, it usually signals that the damage is already done and the recession is just around the corner. So, when you hear that the Fed is preparing to cut rates, it's not a sign of strength, it's a red flag. The underlying mechanisms of the market are already breaking down, and if history is any guide, a recession may already be baked in. Listen to what Gundlach had to say.
So I don't know if that can happen because I think the cutting will weaken economic growth, which may lead to a counter response. It's one of the problems when you get yourself in one of these vicious circles that we've got ourselves in. But I do think the chance of recession is higher than most people believe. I actually think it's higher than 50% coming in the next few quarters.
Wow, higher than 50% for a recession.
Yeah, I think it's 50 to 60 is where I am. Yeah, and I don't think you're going to get a rally out of the long in the Treasury bond market. I think that already happened. We had that Pavlovian response, and we had the 10-year down to 360, and now we're back up at about 4.25, and I'm not sure we're going to go below 4 again. In spite of the fact the economy may weaken.
But even more concerning, Gundlach suggests that we might face a scenario where not only do we get a recession, but we also see inflation at the same time. This is what economists call stagflation, a 1-2 punch of unemployment and rising prices. It's what happened in the U.S. during the 1970s, and it could very well happen again. In 1970, inflation jumped to 5.8%, followed by a recession. Then, inflation surged to 11%, and another recession followed. In the final round, inflation hit 14%, and it wasn't until Paul Volcker pushed interest rates to nearly 20%, causing 2 recessions in the process, that the problem was finally brought under control. In 2022, inflation jumped to 8%, and many are now wondering if this is just the first round of a long battle with inflation, similar to what we saw in the 1970s. Listen to what Gundlach said about the risk of stagflation.
How much of a risk is stagflation? I read, one person's comment today within one news article saying that we already have a, quote, whiff of it, but it's with a small s, not a large S. Is it a real risk?
I think it is. It's certainly non-zero. I mean, the tariffs could very well be inflationary. And the inflation rate is going higher anyway because of the base effects of what's rolling off from last year. And so I think they just downgraded GDP. So we're getting closer to recession. And they just upgraded the inflation forecast, although just for this year. I do think it's kind of wishful thinking to think that somehow magically it's going to go back down to 2% in 2027. But I think that forecast is mostly hope that that's going to happen. We don't see I mean, with the Fed saying they're going to cut interest rates and tariffs coming on, I have a hard time seeing how the inflation rate is going to settle in at 2%.
This all ties back to what we discussed earlier, tariffs. Whether tariffs are good or bad is still up for debate, but many on Wall Street and even some Federal Reserve officials believe that tariffs are inflationary. They push prices higher, and this connects directly to stagflation. If the Fed is preparing to cut rates in anticipation of a weakening economy, but at the same time the president is rolling out inflationary tariffs, we could be setting the stage for stagflation. Here's the final piece of the puzzle, as explained by Gundlach.
I want to get your take, too. You had to figure this was really just a matter of when, not if, that the president was going to weigh in, of course, related to the Fed and interest rates, in which the president posted last night, quote, and we'll show it and I'll get your reaction to it, the Fed would be much better cutting rates as U.S. tariffs start to ease their way into the economy. Do the right thing. April 2nd is Liberation Day in America. What's your reaction to that?
It's kind of par for the course, you know. That's kind of the type of stuff that he does relative to the Fed. But I think he's not going to make any progress with that because the word is inertia. Not, you know, we're not in a period of flux. I don't think he's going to be jawboned into changing his interest rates. Jay Powell should wait and see. He's going to wait and see. And so I'm glad you wrote down that word inertia because that struck me as well. And I really think that defines what the posture of the Fed is for the few months ahead.
I also thought that the op-ed from the editorial board in the Journal today was quite interesting, where they made the argument now that tariffs, quote, give the Fed an inflation foil, that Chair Powell and company can basically pin any spike in inflation from here forward on the president, not themselves, that it gives them, quote, convenient cover. You agree?
I don't see how you could disagree with that. I think that's right. I mean, if inflation goes up, you know, in April, May, then it's pretty easy to say that it's tariffs. And of course, Jay Powell said pretty clearly that he thinks the reason that inflation expectations have gone up by the consumer is tariffs.
So, what does this all mean? We're headed into some rough times, and this will have downstream effects on everything from housing to interest rates. Thanks for watching, and don't forget to hit that like and subscribe button if you enjoyed this video.